All right, let's talk about PROG Holdings. Their third quarter earnings call on October 22nd was a real head-scratcher. You know, one of those classic Wall Street puzzles where the headline numbers look absolutely fantastic, but the market's reaction, well, that told a completely different story. So let's break down exactly what happened.
And this is really the big question we're going to tackle today. The company puts out these great numbers, a strong earnings beat, but then investors just start selling off the stock. So what did they see that wasn't obvious in the headlines? We're going to dig right in.
Okay, so first up, the good news. And it was really good. PROG Holdings reported non-GAAP earnings per share of 90 cents. Now, this wasn't just a beat, it was a total blowout. It crushed what analysts were expecting. They were looking for 74 cents. So PRG beat that by a whopping 22%. That's a super strong performance on the bottom line.
And you know what? It wasn't just the earnings. The top-line revenue, that came in strong too. We're talking over $595 million for the quarter, which beat Wall Street's expectations by about $9 million. So you've got revenue beating, earnings beating, you'd expect the stock to pop, right? Well, that is not what happened. Not at all. In just the 30 minutes after that call, the stock dropped almost 4% in pre-market trading. So the market clearly heard something that made it nervous, something hiding underneath those shiny headline numbers. The big question is, what was it? To really get why the stock dropped, you've got to pop the hood and look at the engine. Because what the earnings report really showed was two completely different stories playing out inside the same company. It's kind of like a tale of two businesses. One is the old guard facing some serious headwinds, and the other is this new growth engine just firing on all cylinders.
And here is that contrast right at the heart of the company. On one side, you have the core business, Progressive Leasing. Its gross merchandise volume, or GMV, fell 10% from last year. Now, management blamed a few things like the Big Lots bankruptcy and the fact that they're intentionally tightening up who they approve. But then on the other side, you've got their buy now, pay later business, Ford Technologies, and it is on an absolute tear. I mean, we're talking serious hypergrowth territory here.
And look, you don't have to take my word for it. The CEO, Steve Michaels, he said it himself on the call. He said, and I'm quoting here, that Ford Technologies has achieved its 8th consecutive quarter of triple-digit growth. That's not a fluke. That's 2 full years of absolutely explosive growth. Now, this is the kind of story investors get excited about, but it was just totally overshadowed by the weakness in the main business.
So, you've got these two conflicting stories pulling the company in different directions. The natural question is, what's management's plan? Well, on the call, they laid out a pretty major strategic pivot. The whole idea is to simplify the business, clean up the story for investors, and really just double down on what's actually working.
They laid it out in a super clear 3-step plan. Step 1, sell off their Vive Financial credit card portfolio. Get it off the books. Step 2, use that move to sharpen the company's focus, right onto their 2 main engines, the core lease-to-own business and that high-growth BNPL platform. And then step 3, take all that cash from the sale and plow it back into growth. It's a classic, smart simplification play.
And we're not talking about a small amount of cash here. The sale of that Vive portfolio to Atlanticus is going to bring in about $150 million. That cash does 2 things. It makes the balance sheet look a lot healthier, and it gives them a ton of capital to reinvest in their main priorities, especially that Ford Technologies business, which is just eating up capital as it grows.
Okay, so let's shift gears and look forward. Because after all the prepared remarks, the part of the call with the guidance and the Q&A with analysts, that's where we got the clearest picture of why the market was so jumpy. This is where all those near-term worries really started to surface.
The company's new guidance for the full year, which, by the way, doesn't include the Vive business they sold, it just felt, well, conservative. The numbers themselves look okay, they're solid, but the outlook pretty much screams that management sees some softness and economic challenges coming up, and that really put a damper on the excitement from that big Q3 beat.
And the Q&A session just dug deeper into those worries. First off, management straight up admitted they're seeing higher delinquencies, which is a huge red flag for consumer stress. Second, those headwinds for the core leasing business, yeah, they're not just going to disappear overnight. And third, even though that BNPL business is a rock star, they told everyone to expect it to actually lose money in Q4. That's because of how they account for all the growth they expect over the holidays, but it still hurts the profit picture for the full year. So, let's put it all together. You've got a strong beat, a smart strategic pivot, but a really cautious outlook. So, what's our final take? Here's how we see the bull case versus the bear case for PROG Holdings moving forward.
The bull case, the optimistic view, is pretty clear. The company makes a lot of money,
Selling Vive really cleans up the investment story, and that 4Technologies business is a legitimate hyper-growth engine that could totally redefine the company. But the bear case is all about the here and now. The core leasing business is soft, the tough economy is really hurting their main customer base, and, well, management's own guidance is telling you to be cautious.
So when you balance all that out, our rating is market perform. The long-term moves they're making are really compelling for sure, but those immediate headwinds in the core business are just too big to ignore right now. It all comes down to this one question that investors have to ask themselves. Can the BNPL rocket ship get into orbit before the legacy leasing business runs out of gas? How that race plays out is going to decide everything for the stock.
And just a quick reminder, this analysis is for informational purposes only. It is not financial advice.